First and foremost, I want to say thank you guys for being here with me today. My name is TC, aka TZ Taught on Instagram. So for this particular video, I will be trying to provide value and show you guys um, how to execute arguably the most important aspect of trading, and that is risk mitigation. It was literally the first thing that my mentor taught me when we sat down, and it's one of the things that I have found to be probably the hardest to explain without actually showing somebody how to do it. Like, I can talk it all day, but showing you how to do it is really gonna be where the proof is in the pudding, so to speak. But every literally every website, stock column, or company or trading guru, which I am none of the above, they will tell you about they will tell you that the number one thing is risk mitigation. But the thing they don't often tell you is how to actually execute that. So today, hopefully, we can help you out a little bit and have you understand a little bit more of how to mitigate your risk and protect your account, because a big part about trading, once again, is protecting your money at the end of the day. So, welcome traders. I'm so glad to have you here. Whether you are a beginner or advanced trader, this is something that can definitely help you out. A lot of times we eyeball it. I know that's what I did before I learned this method. And now we actually want to add a little bit more, let's say, analytics, a little bit more calculations to it so we can actually know what it is that we are risking, what we're trading, what we're making. So, welcome, and I hope you guys learned something. So the materials needed for this course, pretty simple: a laptop, tablet, or cell phone, a notebook, either a digital notebook, so a Google Docs or a Word document, something, or a hard copy, typical notebook, something that you can use to take notes, especially specific notes about maybe you want to do the examples for your particular account size. So that's where that'll come in handy. And probably the most important thing that you can bring with you today is a positive attitude. You'll hear me speak a lot about psychology, and psychology is one of the biggest things in trading and in investing. You'll hear a lot of, once again, gurus, articles, stock columns, things of that nature tell you about psychology. So we like to focus on that because being disciplined is going to be your best friend in trading. Those who honor their trading plans, those who honor their stops, are the ones who are most profitable. And I know I don't trade to throw money away. We trade to make money. So we all have our goals, where there might be financial freedom, where it might be just to add a little bit of pocket change, supplement your um, already monthly income. So let's hop into it and see how we can continue to build that positive attitude and discipline for becoming profitable traders. So our course objective is to learn a simple trading risk mitigation formula to help you make smarter, more profitable trades. Simple as that. Trading is extremely difficult, yet simple. So that's something you'll hear me speak to a lot in today and coming videos, about just keeping it simple. KISS is a formula, is an acronym, excuse me, that I use a lot when it comes to trading, because it's very easy to overcomplicate trading. You can put 100,000 indicators on your chart, and make it as complex as possible, or as complex as you want to, but that's not always, or that's not the only way to be profitable in the market. So keeping it simple is something that I like to focus on. And with that being said, we'll hop right into it. So defining our R. Our R equals our risk unit, okay? So like we were talking about earlier with the psychology, money is a psychological tool, psychological aspect, because money is a tool that is used to build wealth and security, which normally leads to freedom. So what we want to attempt to do here today is break that emotional attachment to that dollar sign. We need to break that attachment to that dollar sign, and how we're going to do that today is we're going to replace that dollar sign with an R. Once again, your R stands for your risk unit. So one of the things we want to focus on as well is to risk less than your potential reward. I've I've been a part of webinars, seminars where there's some traders who advise you to risk 25% of your account on a trade. I don't think that is ideal, because trading is 50-50. You're going to be right 50% of the time, you're going to be wrong 50% of the time. I mean, that's the possibility whenever you place a trade. There's either one outcome or the other. So with that understanding, we need to know that risking less then the potential reward is always going to be beneficial. It's easier to go in and try to risk $1 million to, potentially make 10 million back. But what happens if you lose that meal? Just think about it that way. So there's two facts about trading. And it's funny, I normally, before I say this, Warren Buffett has a very popular rules. He has two rules of trading. Rule number one, don't lose money. Rule number two, see rule number one. But in all honesty, you will lose money on trades. Once again, 50-50. You can either be right when you hit that execute button or you can be wrong. So losing money on trades is a thing. Your goal is to mitigate that risk, right? We want to risk less than the potential reward, right? So our goal, once again, is to risk small and win big. I want to keep reiterating that and driving that point home, because a lot of times we think, or we've heard, that you have to risk big to win big. And that's just simply not the case. So continue to define our R. The number one question and misconception and confusion that I get when I tell people this, which is another reason for me dropping this video, is that risking your R does not mean your investment. Okay. So your R is what you are focused on potentially losing. Okay. If you are wrong on your trade, it does not mean that you can only invest this amount. And you'll see later in some of the examples that we'll do, the investments are actually going to be a little bit larger than the account value. And that is to, once again, drive home the fact that we're defining our R, our risk unit. We're not defining how much we are investing on a trade. Okay, so I hope that makes sense. If it doesn't, we'll continue to try to clarify that. The next thing is position size doesn't matter for the formula to work, although you do need, like I said a second ago, you do need the funds to execute it. So the formula basically tells you how many shares to buy according to your stop loss, to your risk unit. Okay, so the ultimate goal, once again, is to lose as little as possible on these wrong trades, because we're going to be wrong. There's no one in the history of trading who got every trade that they picked right. It's not a thing. So your R should be no more than 2% of your account value. Okay. You remember the example earlier where I said I was in a seminar where a guy was telling, he was very aggressive. So that was just his strategy, and I'm sure his strategy was working for him. But that's not a strategy that everybody can stomach. Risking 25% of your account is a lot. So if you had a $1,000 account, well, that's $250. So if you're wrong, your account is now $750. So you're wrong on two trades. Now you're 50% of what your initial investment was. You're not going to be happy about that. So I was taught, once again, to not spend any more than 2% of your account value. So, and I get a little bit more flexible as your account gets bigger. I've risked as much as 5% on a trade. The risk was a little higher, so my investment, I only bought one contract instead of buying 3 or 4 contracts. But that's another lesson for another day. One of the examples that we like to use here is $5,000 account value. So if you have a $5,000 account, our R is going to be $100, or 2% of our $5,000 account. So just another example down below with, just a few different numbers. So we have a $9,504 account. Our R for this size account, which is based on the 2% that we're risking, we're willing to risk, is $190.08. So that means if I'm wrong on a trade, once my stop loss hits that whatever number I set it for, my limit order will tap me out, because I'm honoring and I'm trying to be disciplined to my R, which is $190.08 here. So how to calculate the shares to buy. This is what it's all about right here. So the biggest thing is, like, we need to know how many shares to buy based off of our strategy, which is our risk unit here. Okay. So at the top is the formula. In example 1, we have R divided by the stop value equals shares to buy. I'm sorry, I have a typo there. Account value. Account value here is $5,000 for this example. So with our calculation, 2% of 5,000 is 100. And for this example, we're going to use Apple's ticker. So when we charted on another chart, and that's another lesson for another day, is we decided, or we're targeting 120 for our entry price based off our support and resistance lines, and exponential and simple moving averages, and our RSI. Those are three of the indicators that I use. But for this one, our entry price is 120 and our stop loss is 118. What that means is, based off of all those indicators that I just mentioned, we feel like if it hits 118 on the chart, then it has a potential to see greater losses. So we're going to stop ourselves out, okay? So how we do this is we set up a stop limit order with our broker for $118, right? So this gives us a difference between our entry price and our stop loss is our stop value, which we'll plug into our formula below. So with our account here, our account R is $100. So we take that 100 and we divide it by our $2 stop value, and that tells us that we now have to buy 50 shares in order to honor our stop limit at 118. So as you'll see at the bottom, like, to clearly reiterate that we're not defining our investment, but we're defining our risk. You see at the bottom, if we were to buy 50 shares at $120, that'll cost us $6,000 investment. So we clearly don't have enough to buy that in our account as we see it right now. But once again, just for example purposes, I wanted to show you guys that this is not about how much money you can spend, okay? This is about how much money you can lose, all right? So with our example, our second example, we're going to same formula, just going to plug in a few different numbers. We have at the top our stop value, our formula, excuse me. So R divided by the stop value equals the shares to buy, okay? Next, our account size, our account value here is 2,500. So half of our first one, which will give us R that is of $50 now, because we took 2% of 2,500 is 50. With this one, we're going to be using the ticker Facebook. Our entry price is $81 and our stop loss is $80. So we probably saw something on this chart where it was moving a little bit aggressively. So we wanted to more than likely just scalp this one. And a scalp is basically where you get in and get out fairly quickly, not really looking to hold on to the shares or the options contract for a long period of time. You're looking to take advantage of implied volatility, theta, and different options Greeks, which once again is a whole nother lesson for another day. But that just gives you an idea and gives you the stop value of 1. So we come down and we plug those numbers in. Now 50 divided by $1 is 50 shares to buy. You see, we used completely different numbers, but we still came back with, based off of our formula, we still came back with the same amount of shares to buy. And now I'm saying 50 is not just always going to be the amount of shares you buy, but I just wanted to show you the flexibility that we are given when we use this formula. So we see once again that our investment is more than our account value, which goes to drive home and reiterate the fact that this is our risk unit. This is not our total investment, okay? So I hope that makes sense. So I just want to recap what we went over a little bit today, to just kind of drive home and give you some things, some nuggets to think about on the way, or when you leave me today, excuse me. So first and foremost, we wanted to just kind of hash out the trading psychology, right? We wanted to break that emotional attachment to money that everyone has. I have it, you have it, billionaires have it. It's an emotional attachment to money. But what we have to do as we try to become more and more disciplined traders is that we have to break those emotional ties that come with money. The way we're doing it in this example with this strategy is we're replacing that dollar sign with an R, which equals our risk unit. So now when we're going into those trades, we're looking at it more analytically instead of emotionally. So we want to always go with the chart, not with your heart, okay? So next, we defined our R, because once again, remember, our R is our risk unit. It is not our investment. Okay, say it again with me. Our R is our risk unit, not our investment. Okay, so I just want to clearly define the difference in the two, a risk unit versus an investment. Okay, so next, we learned our formula. So we learned how to work with our R. So our formula, in essence, the job of our formula is to help us calculate entry, stop loss, and investment based off of our risk mitigation strategy, right? So this is really like the ultimate hack in protecting your account, because anything that involves money, you have to protect it, you know? So there's, with the possibility of losing money, trading, you always want to have a strategy to protect your account from the downside, so you don't blow up your account, because that is a thing. Like we used our example earlier, if we would have lost 2 trades based off of risking 25% per trade on $1,000 account, we're at 50% of our account value after losing 2 trades. After losing 4 trades, you have no more money in your account. So that investment was literally down the drain. So once again, that's just something that is the purpose. That's the overall purpose of this short course, is just to help you protect the downside of your account by knowing exactly what you're risking each and every play. So with that being said, if you guys have any more questions, feel free to reach out to me on IG. You can DM me with any kind of question. You can DM me if you want to set up a one-on-one or drill down into your personal trading strategy, so we can hone in. And remember, we just want to keep it simple. You can literally pick one strategy and search for chart patterns and candlesticks patterns that support that strategy. And once again, my mentor literally showed me how to trade one strategy that he traded for a year straight, trading Apple, and made a lot of money. So it's a very tried and true strategy. And like I said, there's a million strategies out there, but the difference in a profitable strategy versus a not profitable strategy is you. It's you being disciplined enough to execute your strategy the way that you wrote it down each and every play. It's not easy. There's sometimes we let our heart get in front of the chart, So we want to just use these strategies to actually, once again, break those emotional ties and keep us, with our tunnel vision and focused on the mission, which could be whatever for you. Like for me, financial freedom is something that I seek. So this is why I trade. Like I want to be financially free, to where I'm not obligated to be on someone's clock. So whatever it is for you, whether you just want to supplement your income, whether you want to save to buy a house, to buy your kids into college. I don't think you buy your kids into college, but to pay for tuition. That's something that trading can provide. So once again, my goal here was just to provide some value. I hope I was able to do that. Once again, if you have any questions, please reach out to me on Instagram. Feel free to DM me. Also, feel free to check out the link in my bio if you would like to schedule a one-on-one strategy call. So once again, focus on the mission. I appreciate you guys for being here. Love y'all. Thank you. And be on the lookout for the next video that we're dropping.